Restoration Hardware and a crazy gamble that the CEO is planning to pull off, or he actually did already. But how it turns out, that's for the future, right? So that's what we are talking today. I hope your Sunday is amazing. Mine definitely is. I feel fresh and fit, got a new haircut. But Sundays, that's always a great time to a little bit, keep in touch with the news of the past week, see if there are maybe something that we should do with our portfolio, see the changes, and basically prepare for the next week, right? And for some people, restoration hardware might be an interesting bet to take a little bit deeper look into, because simply this is quite a like a binary bet, right? And we'll go over the details in just a brief moment. But of course, with the economy where we are, it's definitely uncertain, right? And that means that we need to be prepared for different scenarios with our portfolio as well. This is definitely not a time to be 100% invested. Also, definitely not a time to be out of the market. We need to be a little bit nimble, cautious. But let's get into the details of restoration hardware. So here is the basically income statement for the latest quarter, and I've highlighted a couple of the details there because obviously with the interest rates, being the highest they've been for in like a decade, 2 decades, it's definitely, let's put it as it is. Like the real estate market is kind of the frozen. Nobody wants to sell, they are sitting on their low interest, mortgages. So there is no incentive for the sellers to sell, right? Which means that there's no movement, right? The prices are also kind of frozen, and maybe, just maybe, when the interest rates, in maybe half a year, maybe sooner, when they will come down, maybe it will, basically kind of open the floodgates, right? And let's see how it turns out. But Gary Friedman definitely thinks that there are some positives in the market. But of course, the past quarter, it was quite rough, right? As you can see, revenue is down, cost of goods sold is up, from 47% to 52%. Gross profits also a little bit slight, 5 percentage points. Income from operations down as a percentage. Interest expense on their debt obviously went up. That means that their net income overall kind of, also declined quite a lot. They are still profitable, so at least kudos for that. But it's definitely a challenging period for someone, right, like a restoration hardware, right? Who they are? They're selling freaking expensive furniture for luxury, real estate. And in my mind, it's almost one of the very few, or maybe only kind of the luxury brand in the US, because let's face it, the only thing that the Europe is providing to the world is luxury. Ferraris, Gucci bags, Hermes, all of these stuff. And restoration hardware is kind of one of the luxury brands that's like a truly American. So, even despite the challenging environment, RH is definitely still pulling some decent net income. But is that going to persist, moving forward? Let's see, let's find out. But what was mind-blowing on the conference call, right? The company repurchased 3.7 million shares in the second quarter, representing 17% of shares outstanding. 17%. That's, basically taking 1/5 of the company off the table. Which, of course, buybacks are one of the great ways how to reward shareholders in the end, the existing shareholders, right? Because, okay, if the company buys back a bunch of shares, that means that the existing shareholders now own a bigger portion of the company, also a bigger portion of the profits. So as long as the buybacks are executed properly, they're actually quite positive, right? But the thing is, right, was that the low point where the buyback should have happened, or it's going to, deteriorate it from here? And Gary admitted it, right? Aggressive move here, but he thinks that our shareholders are going to benefit from that. And he's also, obviously channeling some of the greats like Warren Buffett. We are not like a big corporation that set a regular buyback every quarter and stuff like that. If that was a smart to do, Warren Buffett would do it, right? Warren Buffett is very opportunistic repurchaser for their stock. And we're trying to be opportunistic investor, whether it's in our stock, whether in anything that we do. So we think that was a great time to deploy capital and buy back a meaningful position in our company. And it depends what the market goes. Depends on what we see and how we feel and what we'll do in the future. Okay, so basically if the company and Gary Friedman thinks now was the best time to do the buybacks, that means that from here it's going to be much brighter, right? Well, the market wasn't so in tune with the CEO, to be honest. The stock definitely sold off on Friday. There is also quite a meaningful short position, 16% of the shorts. Some sources are even saying it's 24%. It's always a little bit tricky to find out how many stocks are sell short. But the thing is, and kudos to my friend from Fallacy Alarm, definitely go and check his Twitter or X or how it's called these days, where he basically also highlighted some of these points. Because basically from that conference calls, what you can hear is that the management believes that there will be a rebound over the next 6 months. They call it inflection. And they are still cash flow positive, right? So, but only, like a modest number, right? So they needed to raid their piggy bank. And which means their debt, oh my God, I wrote an article about that, just to sum it up. Let me show you around. Okie dokie. Here we go. This is the RH's debt. Okie dokie. So basically this was in January 22, right? So over the last year, we went from 1.2 billion in debt, net debt, all the way to 3.3 billion, right? So I am not particularly sure this is a good time to have such a high levels of debt, obviously with their interest rates where they are. That's definitely a tricky situation, right? I mean, I would definitely be more conservative as a CEO. That's why I'm basically telling you, hey, this is definitely one for the books. This will go either of the two ways, right? Either, when we forward 6 months from now, Gary will be seen as a genius, hey, that was really the bottom. The market kind of, unfroze again. The people are moving, means they are buying more furniture. But I mean, in a sense, to Gary's advantage, I would say he has a point, right? The market is definitely frozen, right? So like everyone is just waiting what's going to happen, because everyone is also waiting and expecting that the interest rates are going to come at least a little bit lower in quite the near future, right? And people were expecting some cuts, already in the second half of the year. Now it's being a little bit pushed. Hey, maybe it's going to be in the first quarter of the next year. But when that's going to happen, there is definitely going to be some more movement, right? And whenever the people move, to a new house, especially the people that are the customers or of restoration hardware, right? People that have, million, 5 million, 10 million net worth, those people will just, buy new furniture when they move the house, hire a designer and, go around, chairs, tables, some luxury patio. It's going to look freaking amazing, and RH is going to make a bank. So I see his reasoning. That being said, I would definitely be more on the cautious side. So, not a good time. And you can definitely, be cautious in your own personal style and investing. Because once again, right, to kind of sum it up to like a more actionable item for you, what you could do with your portfolio, be prepared, right? Whatever comes. Hey, I have my portfolio, a couple of quality companies, holding for the long term, also have some money on the sidelines. And if you have money on the sidelines, okay, is it just sitting in a bank earning 0.0 nothing? Or do you actually have it in some, CDs, or do you have it in the treasuries, getting at least those 4.5, 5%? That's definitely nice. So in a sense, it's a great market to be in, right? There are so many different opportunities now for you, for me, for our portfolio, but we need to be able to navigate it a little bit more clearly, right? Maybe set up some hedges in place. If your portfolio is, past those 6 figures, it's definitely time to be also a little bit more defensive, right? Because your contribution don't make that much of a dent in the, considering the amount of money you have inside. But hey, let me know what you think. Do you agree with Gary and we are kind of been through the worst and it's going to just get brighter from here? Or would you be a little bit more defensive if you were him and kept that money on the balance sheet? Because I mean, that's one of the things I love for my companies, to be honest. the balance sheet should always be a little bit of a fortress, right? There should always be some money for the raining day, especially, these days with, the amount of money that he used for the buybacks. He could have made so much money on the obviously interest getting for that money. So he's basically saying that, okay, the shareholders of our age are going to get better returns, obviously, from that than compared to putting it just into the treasuries. So it's a tough one. What do you think? Let me know in the comments and let's stay in touch.